everyone, and thank you for joining us this afternoon, and let's talk about understanding financial statements to make key business decisions. The question becomes, why would anyone want to understand and analyze financial statements? Well, answer is simple. We see companies through the eyes of their financial statements that tell us what they own, what they owe, how much they receive in revenue, expenses, profits, and cash flow. So these are the three components of financial statements, or the three financial statements that we need in order to look at the financial status of a company. And everyone involved in that company, all of the managers, all of the participants, all of the stakeholders, all of the investors, all of everybody need to know that. Now, what you see in front of you are three financial statements. The balance sheet, and we're going to talk about all three of these. It tells us what the company owns, what it owes, and what it owns minus what it owes equals its net worth. Second statement is the income statement. There are different terminologies that we use for these, and we'll get into those. But it tells us the revenue that has been received or earned for producing goods and services minus the costs or expenses that were incurred to produce that revenue, and that difference, of course, is its profit or net income. Now, I can hear the folks now who are in the nonprofit sector saying, but we don't have profit. It's the same thing. You still want to make certain that you have a surplus. You still want to make certain that you look at the income you receive and the expenses, which generates a surplus. The only difference in yours and the other profit-oriented businesses is that you don't use that profit outside of the institution. And then, of course, finally, we have the cash flow statement, which what we call, or used to call, I should say, sources and uses of funds. It's all about cash, and I'm going to keep mentioning that over and over and over again. And as we go through this presentation, you'll see the importance that cash plays in this whole idea of understanding and analyzing financial statements. We talk about statements are the language of businesses, how they speak to us, is how a business speaks to us. And it's the same for all types of businesses, the balance sheet, the income statement, and the cash flow statement. Although there may be different terminologies, and I'm going to cover some of those terminologies, for different types of companies. But the statements are all the same. The terminology may be different, but the meaning is all the same. Now, here's just kind of an overview picture of what we're looking at. We take for a business all business transactions that involve dollars, and we transform them through the accounting process. And out of that accounting process, we produce balance sheet, income statement, cash flow statement. The balance sheet tells us assets, liabilities, and equity. That's just a short way of saying what the company owns, what it owes, and how much it's worth. The income statement tells us revenue, what it has earned for providing goods and services, the cost of providing those goods and services, and the difference, of course, being profit or surplus. Cash flow tells us sources and uses of cash. So now let's pause right here and think about this. We could have a company that has thousands and thousands of transactions each month. We can't look at each one of these transactions or analyze each one of these transactions separately and make some type of decisions with respect to the financial status of that company. We couldn't do that, could we, very well? So we transform all of these transactions through this accounting process to generate these three financial statements, and it is these three financial statements that we look at in terms of how to understand and analyze them as a basis for making business decisions. And the same process holds true whether you're a mom and pop store on the corner or whether you're ExxonMobil with millions and millions of transactions per month. Here's what we're going to talk about. Understanding financial statements. First of all, we're going to look at those three statements and see if we can understand them. We're going to look at the key accounting concept very broadly, only just to give you some basis of knowledge for understanding the financial statements. Then we're going to talk about how do we analyze each one of these financial statements. And then I'm going to talk about identifying some critical decision items on each one of the financial statements. And then lastly, we'll talk about the key statements on the key items, rather, on the statements and annual reports. You should have your handout in front of you, and especially at the end, you should have those 3 financial statements in front of you, because I'm going to ask you interactively to go to those 3 financial statements, and we're going to talk about some things on those 3 financial statements. And so that gives you the course outline and the key points. You should have a place to take notes, and as I just mentioned, keep those 3 sample financial statements handy. That's the balance sheet, the income statement, and the cash flow statement, because we will refer to them periodically throughout the session. And as Ron just mentioned, we'll take questions at the end of the session, and we should be okay and be done within hopefully 75 minutes. First segment, understanding financial statements. How do we make these financial statements? I showed you a graphic picture of it before, but let's just take a look at what happens. We take transactions of a business entity, and each separate business entity engages in business transactions. Now, notice the dollar signs. The only ones we're concerned about are the ones that involve dollars. We take these transactions that involve dollars, and we transform them through an accounting process in order to generate these financial statements. And these financial statements tell us the financial health of the company. And we call that the language of business, and those financial statements provide us the what? The results of the business and financial activity of that company. Now, what are these transactions? There are only 6 transactions that any company engages itself in. 6. They either invest funds or they borrow funds. And normally this is at the very startup of the business, and sometimes as you're going through the business in order to expand or whatever. But you invest funds or borrow funds. You buy goods and services from other folks, usually on credit, and if you buy, you have to pay. And then you do what? You sell products and services to others, usually on credit, and then when you sell, you do what? You collect. You collect for the goods and services you have provided. So those are the 6 generic transactions that any business engages itself in, and these are the transactions that we transform into the financial statements. And it kind of looks like this. We show the picture of the balance sheet, the income statement, the cash flow statement. The balance sheet tells us simply what the company owns, and those are assets. So by definition, anything the company owns is called an asset. What the company owes called liabilities. Anything the company owes is called a liability, and the mathematical difference in what it owns and what it owes is called its net worth or its equity. In case the income statement, we got income, which equals its revenue, or what it has earned for providing goods and services, minus the expenses or the cost of providing those goods and services, and that difference becomes profit and loss or net income. In terms of the cash flow statement, we talk about sources and uses of cash. You might say, well, why, if you got all this other stuff, well, why do you need the cash? But you're going to see in a few minutes that those transactions are done as they occur and not necessarily when we receive cash. And the business mathematics looks like this. What a company owns minus what it owes, liabilities equals equity. So you can see its assets, what it owns, minus what it owes equals equity. Or its revenue that it earns for providing goods and services minus the expenses of providing those goods and services equals its net income. Now, does that sound familiar? It should, because it is the same thing as our own personal financial situations. What we own minus what we owe equals our net worth. It's the same thing for a business. And if we look at the income statement of the revenue, it's the same thing as our checkbook activity. We make deposits, we write checks, we have a checkbook balance. So the deposits could be considered revenue, checks written could be the same as our expenses, and the checkbook balance could be the same as our profit or surplus. If you keep it in these simple frameworks, it becomes a lot easier. It's not that complicated, and people often say, well, Accounting is so complicated, it's really not. It's no complicated than understanding how to use your own checkbook. And one lady told me one time, said, Mr. Young, I don't have a clue how to use my own checkbook. I said, well, that's a topic for a different time. So let's look at some of these financial statements. We talk about the three. We talk about the balance sheet, income statement, and cash flow statement. So let's pull out your balance sheet, and let's just go over and see what it pretends to tell us. Okay? Look at the balance sheet. First of all, you see it is a balance sheet as of December of a certain year. We call the balance sheet an as of statement. It is a snapshot in some point in time. The balance sheet goes from inception of the company to the date that we published the balance sheet. I was at a company not several years ago, Gladstone up in New Jersey. They've been in business since 1895, and they had every balance sheet there since the year 1895. And you talk about has accounting changed? No, same thing. Still assets, liabilities, and equity. So now you see this balance sheet has three components. Assets, has liabilities, and equity. Let's look at the assets. What are assets totally? Those are items owned. What are liabilities? Items owed. What is equity? The difference in the assets and the liabilities. Now, the next thing you notice is that we show you 3 years of activity. Comparison. No set of financial statements is worth anything unless the items are compared to something. We can't glean anything from any set of financial statements unless we have a benchmark, unless we have a comparison, or unless we have an expectation or a prior year in order to compare it to. So you see we have years 14, 15, and 16. Now, if I look at any of these items, I can only glean something significant if I compare 14 to 15 to 16. Keep that in mind, but for specific examples, we're going to look at the year 2016. Under assets, we see assets is everything owned. Now, total assets. Let's look at those first of all. We've got total assets of $1,025,000 on 2016. We have total liabilities of $469,000 under 2016. So the company owns $1,025,000. It owes $465,000. So it has an equity or a net worth of $556,000. That is the mathematical difference. And that's why we call it a balance sheet. Whatever the company owns minus what it owes equals its net worth or its balance. And it can't, there's no such thing as a balance sheet that does not balance. Because mathematically what it owes minus what it owns minus what it owes equals its net worth. So now, I think you figured this thing out. What do you want? You want a balance sheet that has large amounts of items owned and substantially less amounts of items owed. And if I compare this to another company, this company has $1,025,000 of owned and only $469,000 of owed. How would that compare to a company that owned $1,025,000 and owed, let's say, $969,000? This would be a far better company. So the first thing you look at is the relationship of what the company owns in total to what it owes. And then you get down into the components. You go to assets and you see we have several categories of assets. We have current assets. And we always show this category of assets called current assets. By definition, that's cash and other items that we expect to convert to cash within a period of 1 year. Let's examine those. First of all, we have cash, and next we have marketable securities. We always list these in order of their liquidity. And next we have accounts receivable. That's the money that's owed to us by other people for having sold them goods and services for a fee. We have inventories. Those are unused items that we have purchased and that's on the shelf that we expect at some point to put into production. Now, remember, current assets, we're going to convert all of these to cash within a period of 1 year, so we have to always keep that in mind. And the reason we always show this separate category of current assets is that we will do some calculations comparing the amount of current assets to current liabilities, and I'll get to that when I get down to the current liabilities. The next category of assets is this thing we call property, plant, and equipment, PP&E. That's our infrastructure. Those are our fixed assets. That's our structures. That's our machinery and equipment, less accumulated depreciation. Now, what is accumulated depreciation? Without getting too far in the weeds. In the accounting context, accumulated depreciation is an allocation process, not a valuation process. We purchase an item that's going to produce revenue for, let's say, 5 years. So for each one of those 5 years, we allocate a portion of its cost that 5 years, and that's the process we call accumulated depreciation. So the value of our structure, or the cost rather of our structures, machinery, and equipment, less our accumulated depreciation, gives us this thing we call net book value. And you can see the calculation in front of you. And then we have land. Well, question becomes, why don't we have land up there in depreciation? Land is always depreciating or appreciating. Remember, this is not a valuation process, it's an allocation process. And the reason we separate land, because land has no useful life. In the case of all the other assets, we account for them in terms of their useful life of producing revenue. Land has no useful life. So we get finished with that category, and that gives us total plant and equipment. The next item would be intangibles. We own them, they're intangibles. What are they? They're patents. They're money that we have invested in developing a patent. And then next we have goodwill. Goodwill only comes about when one company sells another company or one company buys another company. And just for a brief, quick example, if a company has hard assets that it owns of $1 million and another company pays $1.5 million for those hard assets, the question becomes, why would someone do that, and how do we account for that additional $500,000? That additional $500,000 would be done because of what? Could be location, could be customers, could be products, could be positioning in the marketplace, could be revenue potential, could be lots of things that would drive someone to pay $1.5 million in cash for $1 million of hard assets. Well, that $500,000 difference, we account for that as goodwill. And we put that on the books as an asset, and we have one or two choices. We can allocate that goodwill over some extended period of time, or we can leave it on the books. That's just an accounting decision we make. But those give us all our intangible assets, and you add those up on the 2016, we get our total assets. Next come what we owe. That's what we own. Now what do we owe? Remember, we put current assets into a separate category, and we also put current liabilities into a separate category. So the definition of current liabilities are items that we have to pay within the period of 1 year. And so when we get into looking at how do we analyze some of these things, we're going to see that we do a very key analysis of the ratio of current assets to current liabilities. And in this case, you can see all of these items that are we expect to pay within the period of 1 year. Now, I'm going to double back with some of these and show you some of the red flags and some of the things you need to look at that stick out on these statements that you want to be aware of when you see them. But I want you just to get a flavor now of what the overall statement looks like. So those are our short-term assets, short-term liabilities, our current liabilities, and then we get to our long-term liabilities. These are items that we owe over a 1 year period of time or for an extended period. Mortgages and long-term debt. And then, of course, the current liabilities and long-term liabilities gives us our total liabilities, and we compare that to our total assets. And so if total assets are 1,029, total liabilities are 469, we have equity of 556. And that equity comes in two pieces. It comes in capital stock with a par value of $1, and that par value is when we issue stock in a publicly traded company. We often issue it at a par value, which is usually $1. And we assign a $1 par value to it, and then when we sell the stock, we get an additional amount, let's say 15, 18 bucks. Well, that difference in the $1 par value and the 15, 18 dollars is what we call paid in surplus. And then the next one we have is retained earnings. You always want to make certain that a company has retained earnings. What are they? As the name implies, when we earn something, a profit or surplus within a company, our goal is to retain that within the company. And you always want to make certain that a company has retained earnings, because we use that for prior period adjustments, and we use that for unusual occurrences, business interruptions, to restructure the company, to add or advance the company in some kind of way. And you want to always make certain that you don't spend everything that you make in a company, and that's reflected in this retained earnings amount. So we got total assets of 1025, we got liabilities of 469, and we got stockholders' equity of 556. Now, this is stockholders' equity. This could be owner's equity, it could be net worth, and we'll look at some of those terminologies a little bit later on. So let's get on to the next one. Get on to the income statement. Now, you notice the income statement is for the year ended. Balance sheet as of, income statement for the year. We still have 3 years on a comparative basis. Again, one number is not worth anything unless we can compare to something, and we can't glean anything from one number unless we have a comparison of a prior year, a competitor expectation, some type of benchmark. We always, and we look at 2016. 2014 for revenue, you can see 880, 15, 980, and 2016, 1.2. That 1.2 wouldn't mean anything to us, just as an example, unless we could see a comparison to 2015 and to 2014. So we have sales revenue. The next item we have is cost of goods sold or services. You might want to think of those as being the direct cost of producing our products or services. And then the difference in our revenue and our direct cost is what we call our gross profit margin. We also call that gross profit. We also call that contribution margin. So that is the amount that we have to contribute to the coverage of our overhead. And then the next item we have is sales, general and administrative expenses. That's our indirect cost. We normally sometimes call that SG&A. And then the difference in our gross profit and our SG&A gets us this item we call EBITDA. I'm sure you've heard a lot of that lately. That's nothing but earnings before interest, depreciation, and amortization. That's the gross profit, or the profit, if you will, that we get directly from providing our goods and services, as opposed to these ancillary items that we may need in order to run the business, such as interest expense on our loans and such as depreciation and amortization. We may or may not have interest expense in a given year, and we may or may not have depreciation, or it may be different from year to year. And so when I go from my EBITDA minus my interest expense of 11 and my depreciation of 48,000, I get to what I call IPT, earnings before taxes. Then we got to have, famously, our taxes. And then that gives us earnings after tax, EAT. Now I want you to take and circle earnings after tax and circle that 74,000 and earnings after tax, because in our analysis portion, we will come back to that earnings after tax on several occasions. And then you have the common stock dividend if the company chooses to declare a dividend. Normally, the first stockholders get a dividend. The common stockholders get one only if declared. And then the next you see is the increase in retained earnings. This is what you retain in the business after all of your operations, after all of your dividends, and after all of your taxes. This is the number that you retain in the business. Now, notice something else. Notice we do a percentage calculation to each one of the items on the income statement, starting with 100% for revenue, So we calculate every item on the income statement to a percentage of revenue. Why? Because it makes it easy for us to compare our company with another company or this number with a benchmark or an expectation if you're looking at percentages. It also helps you to create this thing we call trends over some period of time. And we call these common size calculations, and we always will calculate each one of our items. It helps us in forecasting, it helps us in planning, it helps us to better understand quickly exactly what the dimension of these amounts are, because we look at them as a percentage of revenue as opposed to just a raw number. Let's take a look at our cash flow statement. Now, you say, why in the world do you need a cash flow statement if you've got all this other stuff going on? Well, we're going to talk in a few minutes about accrual-based accounting and cash-based accounting. And we account for our companies on an accrual basis. That sounds fancy, but it's not. It only says that we record transactions as they occur, not when we pay for them, but as they occur. So, if we record transactions as they occur rather than when we pay for them, how do we account for the cash? Well, then we have to take these transactions that we produce on the statements as they occur and convert them to cash. And that's what the cash flow statement does for us. You see the cash flow statement has three components. It has cash from financing, cash from investing, and cash from operations. Let's look at financing first. Cash from financing is if we mortgage something or when we invest in the business as a startup, and that's where we say the transactions are the owners investing in the business. At some point, we would expect that not to be the case. On a startup, yes, but at some point, we expect the company to stand upon its own and create enough cash from its operations to sustain itself. Next, we have cash flow from investing. When we invest in the plant and equipment, we calculate that cash flow. And then the third piece we have, and probably the most important piece, is cash flow from operations. We go through each one of the components on our income statement and our balance sheet, and we essentially convert them from an accrual basis to a cash basis. Starting with net income, we take the net income from our income statement and we plus or minus all the other items on the income statement and on the balance sheet that might pertain to cash, and we record that as cash flow from operations. So you can see starting with net income, and we get down to the bottom where we show pluses and minuses to all of those components, and that would take a whole session to go through that. And then we get down to cash flow from operations of $83,000. If you take the cash flow from operations of $83,000 minus the cash flow from investing in plant and equipment, minus the cash flow from paying off from the financing activities of $45,000, we get net cash increase of $18,000. Okay, the other purpose of the cash flow statement is to balance out the cash, or we call it tie out the cash on the balance sheet to the cash flow statement. So you can see we've got net increase in cash during the year of $18,000. If you look at your balance sheet and see the cash on hand at the end of 2015, you see what, $142,000, right? If we increase cash by $18,000 in the year 2016, and we had a balance of $142 at the end of 2015, that shows, or that means we should have, what, $160,000 at the end of 2016, and lo and behold, that's exactly what we have. So that ties. The last thing I want to talk about on the cash flow statement is this thing we call free cash flow. Hot item, hot buzz item. Everyone talks now about free cash flow, free cash flow. Free cash flow is rapidly replacing earnings per share in terms of being the commonly accepted metric for understanding the wealth and value of a company. And free cash flow is nothing but cash from operations minus what we spent from capital expenditures, and that's free cash flow. What that says is that's the amount of free cash we have within the company in order to support sales and operations. Now, you might have figured out something just now. You might have figured out something. I'm going to give you a little hint. What's the most important thing we do in a business is maintain that we have enough cash to meet our obligations as they become due. Keep that in mind as we go forward within the presentation, because you'll need to have that to understand this stuff. Now, here's what I want you to do. Rank these three financial statements in terms of which ones you think are most important, which one you think is next most important, and perhaps third most important. Now, I know they're all important. I know that. But if you had to choose one over the other, which one you say I would have to have, or in terms of running my business, the one that's going to be most important to me, which would it be? And which would be the second most important, and which would be the third most important? So I want you to take your sample financial statements, write a 1 at the one on the top of the one you think is most important, a 2 where you think is next most important, and a 3 that you think is third most important. Let's see where we go. Ta-da! What you have is number 1, cash flow. Always cash flow. A company thrives, survives, lives, or whatever on the ability to meet its obligations when they become due. That's cash. I can have all kinds of profit and no cash. I can have all kinds of cash and no profit. It's cash. All the other stuff is a calculation of what was done here versus what was done here in terms of revenue and expenses. But where the rubber meets the road is cash. Now, second, what do you think? It's a balance sheet. The balance sheet tells us at any point in time the snapshot of what the company owns and what it owes. That's our current snapshot. And thirdly, it is the income statement. It's got to be the income statement because it's profit. Well, profit doesn't mean anything. It's cash. And most of the operating folks always say income statement because that's how they're measured. If you ask any type of owner, any type of investor, any type of banker, any type of other stakeholder, they will always tell you the most important thing in managing a business is cash. And the next most important statement is the balance sheet. And thirdly, we have the income statement because remember, the income statement only gives us information for one accounting period, whereas the balance sheet tells us information from inception to date. Okay? So let's look at how we get to these things, these key accounting concepts in segment 2. What are your top 3 thoughts about accounting? I've been teaching this accounting stuff a long, long time. Everyone thinks, oh, man, accounting is complicated. Well, it's not. They say, well, it's easy for you to say you've been doing it since 1895. It's not that complicated if you keep it simple. Most folks have these unusual ideas about accounting, and these are some of them. What do you say? Everyone says accounting is complicated. Well, it's not really. Well, it's easy for me to say. I've been doing it a long time. But if you think of it in terms of your own personal checking account, your own personal financial side, it's not that complicated. It's just a matter of what you own minus what you owe and the difference. And we say it's science. Accounting is not science. Accounting is an art. The toughest in teaching accounting at a college level for years and years and years and doing seminars, the toughest thing to get across to people with an engineering mindset is that accounting is not science. We do accounting based on certain concepts and certain principles, which I'll show you in just a couple of minutes, but it's not science. It's not mathematics. All we do is add pluses and minuses, what we own minus what we owe. We don't do any abstract calculus, any quantum physics, anything like that. And we say accounting is boring, and it probably is, but someone has to do it. Someone has to take all of these many, many transactions that a company engages itself in during a year's time and transform those transactions through the accounting process to produce those 3 nicely prepared statements so that your owners, your managers, and your stakeholders can look at this thing and make decisions about the company without having to analyze separately thousands and thousands of transactions. Then they say accountants are dull. I'll let you be the judge of that. Accounting is based on 4 building blocks. I'm going to put them all up at the same time so you get the concept. we say we look at every business as being a separate entity, separate from its owner, separate from anything. I worked 6 years for Ross Perot's company, Perot Systems, and Perot Systems was separate and aside from Mr. Perot himself, who was a billionaire. Perot Systems did not have $1 billion, so it is separate from its stakeholders and everything. And we also call it a going concern. That's an old English term which says it is. We expect that the business to be in business and keep going in perpetuity and to make a profit. We consider it to be a going concern. Now, if we didn't consider the company to be a going concern, then how would we justify doing a lease for 50 years or 100 years, as some oil companies do? So we consider that the company will always be in business and will always make a profit. The next one is the period. All of these transactions that we're going to be transformed into the accounting statements, these transactions never stop. They happen in a seamless flow of transactions. But we can carve out of those transactions any period that we wish. Our weeks, our years, our months can be whatever we do, so long as we do them on a consistent basis. And, of course, we have the monetary concept. Everything we do relates to dollars. That's the only thing we're concerned with is dollars, and we're concerned that these dollars are stable dollars, or we consider that they're stable. So those are the concepts. And we have this whole thing I mentioned before about whether it's cash or accrual basis. We do everything mainly on an accrual basis, and that simply says we record transactions as they are incurred or as they occur. And then on a cash basis, we record revenue and expenses only when we receive cash or pay out cash. Which do most companies use? Most companies use the accrual basis, recording revenue when it is earned, and when is it earned, when we provide the goods and services and send our customers a bill. And then we record expenses when they occur. Think of it. If I'm going to record the revenue when I earn it, I have to also record the expenses that pertain to the earning of that revenue at the same time. Although I've not gotten paid for my revenue, but in most cases I might have paid for the labor that's associated with it or not. So we account for things on an accrual basis, but you've heard me mention cash lots of times, but we manage on a cash basis, meaning our main concern in everything we do is this the best use of my cash at this point in time? Okay, concepts. We do accounting based on certain principles. First is the historical cost principle. Just going to go through these briefly so you can get a flavor for them. Historical cost, we record all transactions at their cost at the time we record the transaction. That's simple what that says, matching. If we're going to record revenue in a certain month, whether we receive the cash for it or not, we have to record the expenses that we used to produce that revenue in that same month. Materiality, we have various ways of recording transactions, and what will guide us to record transactions in a certain way is materiality. Quick example, if I buy $600 worth of supplies, and those supplies will last me for 6 months, I got one or two choices. Record the whole $600 in the month in which I buy the supplies, or record $600 in 1 month and then allocate the $600 over the months that the supplies are being used. Which one is best? Doesn't matter. Your choice. And you would make that choice based on how material that is. If it's ExxonMobil, it wouldn't be material at all. You wouldn't even worry about it. If it's a small mom and pop company, it would be material. So you would record it as you use it. But that's what we say that you can ask 11 accountants a question and get 13 different answers, because we get away, we're not into the science of anything, we're into applying these concepts and these principles as we record transactions. And once we choose to do something a certain way, we have to maintain the consistency of doing it that way. And then, of course, we have conservatism. Accountants by nature are conservative. That simply means that we will tend to always understate revenue when we have a choice and overstate expenses. And that's the conservative nature of what we do. So we want to make certain that when someone looks at the financial statements, they have a good safety zone, or they feel comfortable making decisions based upon those statements, because we have been very careful not to stretch the point of revenue too far and not to stretch the point of expenses in the wrong way. And then, of course, we have to have full disclosure. Everything we do has to be fully disclosed, whether it is either a monetary or a transaction or a non-financial item that might impact the financial system of financial statements that in the eyesight of someone. And then, of course, these are what we call generally accepted accounting principles, and we get them all from FASB, which is the Financial Accounting Standards Board, which is the accounting arm under the Securities and Exchange Commission. Now, let's look at how to analyze these things. Are traditional financial statements effective in managing an enterprise? Everyone's going to say, yes, 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 I know they are. Are they? Think about it. And I want you to think about it and think about why. I always get some pushback on these, so I have to really be careful what I say here. But are traditional financial statements effective in managing an enterprise? You say, well, if they aren't, then why do we do it? Well, here's the point I'm trying to make. Accounting, we produce these financial statements using accounting. But all that is a record of the past transactions. So we have taken transactions all for the month of, June? All for the month of May, and now we have closed the books out at the end of May, and now we're into the 15th of June looking back to see what went on in the month of May. In the meanwhile, the company is moving forward, so we have to make decisions on the company in June based upon what's going to impact the company in June and going forward, and that's what we call the finance approach or the futures approach. And it is for that reason that we don't think the traditional financial statements are the best weapons to use in order to guide the company in the future. And that's just another example of it. Accounting gives us the past, recording, reporting. Finance gives us the future, forecasting, and decision making. However, we have to take what went on in the past, this is where I always get the pushback, and use that as the basis for doing what we do in the future, and that's where forecasting and all of this stuff comes from. So we don't disregard what went on in the past, but our focus should be more on what's going to happen in the future and taking what we glean from these financial reports in the past and apply that to what we can expect or what we hope to have happen in the future. It's that whole forward-looking approach I want you to think about. Let's take a look at some balance sheet terminology. When I do these sessions in the open, folks say, oh, man, you guys got all these different terminologies, and I come to this thing because I don't have a clue what you guys are talking about because the terminology is always so different. Balance sheet is the most common. We normally call it the balance sheet. Why? Because it balances. There's no such thing as balance sheet that doesn't balance. It tells us assets, simply items owned, liabilities, items owed, and that difference is called net worth. Could be called equity, could be called lots of other things. It also could be called financial position or condition. Some banks and some credit unions use that phraseology. It could be called standard of net assets. Some private equity firms use statement of net assets. Net worth is sometimes called owner's equity, stockholders' equity, and net assets. All of these are terminologies that you see related to the balance sheet that effectively mean the same. If you're going to look at a balance sheet, what would be several positive signs of good financial health on the balance sheet? I think we talked about most of them when we went through the balance sheet, but what we think would be some good healthy signs. Let's take a look at them. I want you to focus on your balance sheet, and let's see if we can pick out some good, healthy, positive signs if I'm looking at the balance sheet. First of all, you want to have year-to-year comparisons. You can't glean anything from anything unless you have some type of comparison or some type of trend to compare it to. You want to have, as I mentioned, more assets than liabilities. You want to have a greater split between what the company owns and what it owes. A company that owns $1 million and owes $999,000 is not nearly as good a company as one that owns $1 million and only owes $300,000 or $400,000. So you want to look at that overall split. And you want to make certain that you have adequate but not excessive inventories. Why do I put inventories up here? Because that is the bane of our existence. Companies go down the tube more than anything because of inventory. They simply have way too much inventory on the shelf, and that's costing them operating money on a daily basis, and they have that because someone comes by and offers them a sweetheart deal, and they buy all this inventory that sits on the shelf collecting dust. And when turnaround folks go into companies, the very first thing they look at is the amount of inventory you have on hand. You want to make certain a company has adequate cash. And so why is that important? Adequate cash because you got to meet your obligations as they become due. How can you tell that? If I look at my accounts receivables and if I look at my inventories and I keep seeing the increases in inventories and the increase in accounts receivables, all that tells me is that I'm burning cash by buying inventory. I'm selling products without collecting, so I'm not getting my cash. Remember, current assets, we expect to convert all of those items to cash within a period of 1 year. And we have a good liquidity ratio. I'm going to show you what the liquidity ratio is in a minute, but that's the ratio of my current assets to my current liabilities. Remember, you got to have cash and there are other items, and less in terms of current liabilities, and that's why we always isolate current assets and current liabilities. You want to have reasonable debt. Debt is a demon. It should be avoided at all costs. And you must have reasonable debt, not excessive debt. And you want to make sure that you are a company is aggressively collecting its receivables. How can you determine that? If I look at 2014, 15, and 16, on my sample balance sheet, I see what are receivables. I see receivables going up slightly. That a good trend? Probably not, because it seems to me that I may be increasing my receivables. I want to see my sales going up for sure, but also want to always see my receivables going down because I'm taking aggressive steps to collect my receivables. And if my receivable is sitting on the books and I'm not aggressively collecting them, that means I'm not turning my receivables into cash. And I want to make certain I'm promptly paying all of my payables, not beforehand, but I'm paying them on time when they are due. Now, why don't I want to pay them ahead of time? Because I burn my cash, and I don't want to burn my cash until I necessarily have to. Yeah, but what about this whole idea of 210 net 30 if someone offers you a discount? Well, why do you think they offer you the discount? They offer you the discount so they can get your cash ahead of time. And then they use your cash to do something within their business to make up for the 2% that they gave you. Only pay invoices when necessary, when you have to. And you want to make certain you have adequate working capital. I go back to current assets. I go back to current liabilities. And now the difference in those current assets and current liabilities is what I call working capital. Working capital meaning the amount of capital I have on hand in order to support my sales and operations. But that's only as valid is the amount of cash. And I'll show you an example of that in a couple of minutes. Now, what about the red flags? Look at the balance sheet. Just the opposite of what we just talked about. Excess inventory. Anytime you see accrued expenses or miscellaneous expenses, red flag. Maybe right, maybe okay, but you want to drill down and make certain you know exactly what's in there. You want to always carefully examine inventory. If I have increasing receivables and payables, that is a red flag. That means I'm selling my products, I'm not aggressively collecting my accounts receivables, and what's suffering? My cash. Goodwill is always a red flag as to how it's being treated. Is it being systematically amortized? Is it remaining on the books? Is it an extended period for amortization or a shorter period of amortization? All I'm saying, these are red flags, and you can always drill down and see what those are. Loans to owners, huge, huge red flag. Is there an arm's length transaction or is there documentation available? What is the loan? Why were they given? Is there a payback period? Is there interest? If there was no interest, you have to impute the interest and all of these things for tax purposes. Depreciation and amortization, once again, am I using reasonable periods of time to depreciate my products? What is depreciation? Systematic write-off of tangible products, amortization, systematic write-off of intangible assets, like goodwill or organizational expenses or software development, or those types of things. Retained earnings, I want to make certain that I am retaining earnings within the business. And so I would expect my retained earnings to be increasing, because that says I have strength, and if I need to have a business downturn or a business interruption, I have retained earnings to do that. Let's take a look at the income statement. What are some of the terminologies? Income statement, most common. Boy, do we have all kinds of names for these things. Revenue, we record it as it's earned. Expenses and costs, we record them as they are incurred or occurred. And our profit is simply the difference. And we take our profit and loss, could also be called net earnings. Revenue is sometimes called sales, fees, services, turnover, gifts, exchanges, donations, contributions, gains, offerings. All of these things are what we receive in exchange for providing goods and services, or if I'm an Elon Mercenary organization, what people donate to me because of my public good. Expenses, we call those costs of sales. Those are direct. Cost of sales, we have indirect. That's our SG&A, administrative, operating costs pertaining to the product, administrative costs, overhead. You want to always be careful about administrative costs, because that's the most difficult cost to measure, because you can't tell how well it's contributing to the production of your product. Sometimes in direct costs you can. Profit equals net income, EBITDA, earnings before taxes, depreciation, earnings before, interest, taxes, depreciation, and amortization. And then, of course, you have earnings after tax. Those are all just the terminology associated with income statement. Once again, what are some of the positive signs of a business based upon its income statement? Let's take a look at some of them. Again, year-to-year trend. Can't glean anything from any set of financial statements unless you have comparisons or some basis of comparisons. And you want to always make certain that your revenue is increasing. That's ideal. And you can only tell that by looking at the year-to-year comparisons. And you want to look at your cost of services to revenue. What am I saying? I'm saying if your revenue is increasing and your cost of services are remaining somewhat static, that's a good sign. But if your revenue is remaining flat and not increasing, and your cost of goods and your cost of services are increasing, that's an issue. That's a red flag you're going to look at and say, well, is it pricing? Are my products priced too low? And what I'm saying, all these analysis things, we don't intuitively get the answer, but it tells us where to go look. That's not a good sign. That's not a good trend. And you want to make certain my expenses are controlled or decreasing, and that's a real big issue in any company, is a cost control or my interest. Cost control or my expenses decreasing. You want to make sure you got limited interest expense. It means you got what? Less debt. And if you're having a lot of debt, a lot of interest expense, you have to cover that with your income, and that impacts your profits, because you're borrowing a lot of money to operate your business. That might mean you're not collecting your receivables aggressively enough, or you're not rolling your inventory into products as aggressively as you should. And you want to make certain you have adequate depreciation and amortization. This can really get to be an issue, because if you're taking not a conservative approach, if you're buying, for example, if you're buying a piece of machinery and you know that machinery will only last for 3 years, you should depreciate over a 3-year period of time. But now, if you go buy that machinery and you say, well, I know it's going to only last you for 3 years, but I'm going to stretch the books and I'm going to depreciate over 10 years, all you're doing is kidding yourself. Because you can show profits increase in that way for a period of time, but at some point you got to pay the piper. And you got to watch your taxes. I see most small businesses get themselves in trouble because they don't pay their taxes, in both income taxes, their payroll tax deposits, and their sales taxes. And the key item on any income statement is this thing we call earnings after tax. And you want to make certain that a good company has always increases in retained earnings. And yes, I do see the one too many A in increases. Okay? What are some of the red flags? No multiple years. Once again, you can't do anything unless you look at multiple years on the income statement. Same thing, accrued expenses, miscellaneous expenses, those are red flags, folks. Drill down and see what's causing that. So you put accrued, miscellaneous, and other all in the same category. That's a red flag. Circle that. What is it? And you have write-offs and adjustments. That's also a red flag. And you have what I call the small gap in the revenue and cost line, meaning you are spending money as quickly as you get it in. Your revenue and your costs are right with each other. So when revenue tends to bend downward or you lose revenue, you have no place to go because it runs right into your cost line. And you got increase in SG&A expenses. This is a death nail for companies because they get a creep in the scope of their sales, general and administrative expenses, and there's no way to measure that. How do you measure the effectiveness of sales advertising? Tough to do. You keep adding these things and they are a drain on your profits, but you can't really measure how effective they are in terms of your revenue. And of course, the final death nail is that if you keep having decrease in profits. Decrease in profits means what? You got to do something about cost. You can't, in most cases, control revenue, and the only thing you can control is cost. Now, that thing I mentioned before, where it says small gap in revenue and cost line, here it is. You got cost going up rapidly, and revenue going up rapidly. You got your cost going up right behind revenue. So you have a small gap. You should be trying to maintain your cost at the C line or the optimum control line so that when revenue bends the other way, you have a wider gap in which to retrench yourself before you have to do something to cut off costs. Business boils down to three things: cost, customers, cost, and cash. You must control your cost. Let's look at some critical decision items. If you were considering doing business with a company, what items would you consider to be critical? Cash, ability for it to meet its obligations as they become true. That's liquidity, and I mentioned that over and over and over again. I'm going to show you how that's calculated. And cash to support its sales and operations. That's working capital. I'm going to show you how to calculate that, but I'm going to tell you that's all tied to the amount of cash you have on hand. And then, once again, a short cash-to-cash cycle. Everybody needs to know that cash-to-cash cycle, and I'm going to show you what that is because you have to make certain that you have enough cash to meet your obligations as they become due. Because we must consider cash in all of our decisions. Every decision we make in business has a calculated decision. It has maybe a business options decision, which is what? Common sense. Although I calculate this to be what I should do, is it make good common sense for me to do it right now? And that normally hinges upon, is this the best use of my cash at this moment? Because if I spend the cash at this moment, it's gone. I can't get it back. Because our gross profit and net profit, those are only just calculations. What the real is in all of these things is cash. So let's take a look at that. We've got three things up there: current ratio, ability to meet obligations as they become due, quick test ratio, and what I call Carl's conservative ratio. Let's look at the current ratio. Everybody calculates the current ratio. That's the commonly accepted way of understanding how liquid a company is and whether it's able to meet its obligations as they become due. Why do we do it? How will we meet our obligations? What's the formula? Current assets over current liabilities. In this case, under 2016, we got $595 in current assets. We got $184 in current liabilities. So that says, theoretically, that we got $3.02 that we expect to have in cash within a period of 1 year to every $1 that we have to pay out. Is that good, bad, and different? Well, it depends. Depends on is that a solid number? Some folks say 1.8 is good, 2.0 is good. It depends on how conservative you want to be. But the point is, it measures how well you meet your obligations as they become due. Now, this is a calculation of current assets. But once again, those current assets are only as valid as what? As you are converting them to cash. In terms of inventory, in terms of accounts receivable. So this calculation is only just an indicator. You got to convert your receivables to cash and your inventories to cash. Now, the quick asset test ratio is that we eliminate inventory. And this is what the bankers will use. They'll take your current assets minus your inventories over your current liabilities. And they call that the asset test ratio. In this case, once we eliminate inventories, we get down to 470 over our 184, looking at 2016 from our balance sheets, and it gets us back to 255, from 322 to 255. And so this is what banks will use in order to measure how liquid you are to meet your obligations as they become due. Now, what banks will also do is not only do this, but they will also discount your accounts receivables by between 25 and 55% based upon your creditworthiness. No easy ride, folks. Here's my conservative ratio. When I was the CFO of a $275 million company, I'm a very conservative accountant. And I always looked at cash and cash equivalents of my current assets and how they compare to current liabilities. Many CFOs use this calculation. But I always wanted to make certain that my cash, or the money I could get my hands on right away, cash and cash equivalents, I had my current liabilities, money that I had to pay right away covered by at least 2 to 1. But that's very conservative. Now, you may not be that conservative at all, but that's what I did because I like to sleep at night. Now, I've seen some large companies who have 1 to 1. Some of them have 9.9 to 1. ExxonMobil, for example, has 1 to 1, but they got $1 gazillion of cash in the bank, trust me. Okay? But it all gets back to cash. Now, here's something else. We've got working capital, cash flow, and cash-to-cash cycle. What is working capital? That's how we support our sales and operations. Working capital is the same thing as current ratio, except we take current assets minus current liabilities, and that gives us working capital. So now let's take a look at 2016. You got 595 in current assets. You got 184 in current liabilities. That would suggest to you we had $411,000 in working capital. And let's say we want to do a project for $300,000. We say, oh, let's go do it. We got enough working capital. But hold on, pump the brakes. That's driven by cash availability. Although we calculate working capital to be $411,000, we only got what? What do we got? We got $160,000 in cash. So we are restrained by our cash availability. Once again, adding impetus to the fact that we have to aggressively pursue the conversion of our receivables and inventory to cash. Free cash flow. We talked about this before. It's cash from our operations on our cash flow statement minus what we have in what we have spent for capital improvement. And our cash from operations in this case is $83,000. We've spent $20,000 for plant and equipment. So that says we got at least $63,000 of free cash that we can use to support sales and operations, which seems to make some sense because we got $140,000 on hand. But this tells us the free cash we have available. And that's gradually replacing this thing we call earnings per share in terms of the acceptable corporate metric for corporate success. Now here's this cash-to-cash cycle. You must always know your cash-to-cash cycle. It's the cycle that says when I spend money, how long does it take me to get that money back into my company? And in this case, we spend money on 1st of September. We use it with inventory and labor to produce products and services that we send our customers on the 30th of November, and we collect the cash by the 31st of January. That's our cash-to-cash cycle. That's our cash recovery period. So what do we want to do? Keep that as short as possible so that a company is operating on the inertia of its own cash flow. You say, well, I got 30-day terms. Well, if it takes you 15 days to get your billing out to your hands to your customers start that 30-day count when they receive your bill. So in all of these things you're doing, you need to be trying to cut down on how long it takes you to get your products into the hands of your customers. On the front end, you got to make certain you're being more cutting down on the amount of inventory turnover and making certain that you're being as productive in the application of your labor. But you want to make certain you know your cash-to-cash cycle. Folks, it's all about cash. Cash is the, no matter what your gender preference, all about cash. King or queen, as the saying goes, no matter what your gender preference is. It's all about cash. So now let's take a look at some of the items on the last segment here. Some of the items on the financial statements. I'll just put these all up here at one time. You won't always start from the back. I'm talking about that fancy set of financial statements you get from somebody. Always start reading from the back. Look at the footnotes and disclosures. And that's always where you see the management discussion as to how management views the company, its progress, its status. The footnotes and disclosures, you get the full disclosure because everything must be fully disclosed. And you also get the key financial highlights. Each company has a set of key financial highlights that they want to give you.